Now, Grant Cardone says never, ever, ever buy anything under 16 units.
Mhm.
And I agree. It's always better to scale up and go as big as possible because of economies of scale and a few other things we'll talk about. But you have to start somewhere. And for the right deal, it's absolutely a great idea to buy a townhome or a duplex or a fourplex or a triplex. So I would say financing is really, really good.
The other benefit that I see, Sam, is once you get into the commercial, and I didn't know this, there's huge tax incentives, man, for
Mm-hmm.
doing the bigger commercial buildings like the larger apartment complexes. And I think that's one thing. And we'll dig a little bit into it a little bit
Yeah,
later.
for sure.
That's one thing that I didn't really know, and I think that it's important for consumers to know that not only when investing in real estate, you have to look at, okay, what type of return am I getting? But if you're a high income earner and you need some tax shelter, what kind of tax benefits can I get from investing in maybe something a little bit larger? Would you?
Absolutely. I think people get intimidated by the numbers, the high purchase price. I think that's the only negative. Once, and here's an age old story. You're talking to this seasoned real estate investor, and he'll tell you that he started with duplexes, he started with fourplexes, and typically what he or she will say is, "I wish I had never done the duplexes or fourplexes. I'm glad I did because I learned a lot, but I wish I would have jumped straight into big multifamily because there's so many, just like you were saying with tax advantages, there's so many positives and advantages to going bigger. And, like you said, we're going to talk about those.
Hi, everybody. It's Luis Morales with the Morales Group Real Estate Show. Welcome back. Today, we've got a very special guest. This is episode number 37. We've got Sam Newell. He is a real estate agent, real estate investor, hotel owner, has sold over $100 million in real estate or done over $100 million worth of transactions. And today's topic, he's going to be talking to us about investing in apartment complexes. We're going to cover everything from investing in maybe a duplex, a triplex, fourplex, all the way to buying 300 units at one time. So welcome to the show, Sam. How are you?
Hey, man, great. Thanks for having me on. I'm excited to talk to you about my favorite topic, which is multifamily.
Absolutely, man. I'm excited to have you because obviously, a little selfishly, I know that I'm going to learn a couple of things here myself. So a part of it is a little bit selfish, but I think that it's great content to provide to consumers out there. So let's jump right into it. Sam, what is the difference between like a residential? And I hear a bit of an echo. Let me see if we
I'm
have.
going to turn down my volume a little bit. Is that
Oh,
better?
I think so. Do you, yeah, I don't hear it anymore. Okay, great.
Okay.
So what is the difference, Sam, between buying like a multi-unit apartment that's like maybe like a duplex, a triplex, and maybe buying something that is 4 units plus?
So the biggest difference really is just the financing. So the really cool thing about 4 units and under is you can get a residential loan. So you go to your mortgage officer that sold you your home or helped you buy your house, and he can typically help you buy a duplex or a fourplex with very, very favorable financing, 30-year amortization, 20 to 25% down. And it's not really very hard or very different from qualifying for a home loan. And that's the huge advantage from 4 units and down. Now, Grant Cardone says never, ever, ever buy anything under 16 units.
Mhm.
And I agree. It's always better to scale up and go as big as possible because of economies of scale and a few other things we'll talk about. But you have to start somewhere. And for the right deal, it's absolutely a great idea to buy a townhome or a duplex or a fourplex or a triplex. So I would say financing is really, really good.
Yeah, so it's the financing that's a little bit more attractive on a
Mm-hmm.
residential apartment complex, anything 4 units or below. And then once you jump into that, it changes. So let's talk about that a little bit. Like for example, like if somebody was going to purchase a duplex, how much money would they need down versus if somebody was going to maybe purchase a 5 unit? What does that look like?
So the down payment doesn't change a whole lot.
Mhm.
You can buy let's say a townhome as a rental or a single family home as a rental, and you can put 20% down.
Mhm.
If you buy a duplex, triplex, or fourplex, typically they're going to require 25%, but there are credit unions around me at least that will do loans for 10% down on an investment property. You typically are not going to see that for 5 units and up. There's going to be a strict rule of 25%, and there may be also some type of debt coverage ratio. So how much of the debt will the rents cover? Usually it's 1.25 that they also require. You don't typically see that requirement on a duplex or a fourplex.
And one of the things, I don't know if this is just exclusive in my area, but one of the benefits as well too, Sam, is that I mean I've seen people purchase a duplex, a triplex, or even a fourplex. I had a client purchase a fourplex with an FHA loan, three and
Oh
a half
yeah.
down. So
Yeah.
essentially, I mean, I'd say that's a major difference. Sometimes, I mean, on a 4 or 5 plus unit, you've got to put 25% down, 30% down, and you don't really get the benefits of doing that. The way that I
Yeah.
look at it, to kind of share some perspective, it just depends at where you're at in your investing career. I mean,
Right.
the person that starts off with the fourplex, he lived in one of the units, eventually moved out, and now he's got great cash flow on that multi-unit property, and he's used that to buy other bigger stuff as well too. And you could always exchange it as well too and buy something larger. Use the fourplex to get you going to a sixplex, a 12plex, a 20,
Yep.
and all that good stuff as well too.
Well, and that's why I don't necessarily agree with Grant Cardone. You have to start somewhere. And house hacking, what you're talking about is nowadays it's called house hacking. It wasn't back when I started. There was no. It was just called owner occupying. So you owner occupy an investment property or house hack it. You live in it, rent the other units out, and it's a fantastic way to build wealth and a fantastic way to get started in real estate investing and really learn the ropes and there's people that do it. My clients do it. I've done it. I've done it on 6 properties now. So I've house hacked 6 different properties, and exactly what you're saying. I've made great money. It's not optimal, it's not a dream home ever. It is a sacrifice, but I've done really well house hacking homes, townhomes, and also multi units.
Yeah, well, I think sometimes being conservative at the beginning puts you in a better position to buy the larger complexes. Because I mean, I started off with a single family residence, and I basically ended up selling that single family residence and buying a fourplex with that. And now I'm considering selling that fourplex and buying like a mobile home park or like a 39 unit something down in my neck of the woods. So
Nice.
essentially, sometimes you can take the equity and use that as a stepping stone to be able to
Absolutely.
something bigger and eventually better. The other benefit that I see, Sam, is once you get into the commercial, and I didn't know this, there's huge tax incentives, man, for
Hmm.
doing the bigger commercial buildings like the larger apartment complexes. And I think that's one thing. And we'll dig a little bit into it a little bit
Yeah,
later.
for sure.
That's one thing that I didn't really know, and I think that it's important for consumers to know that not only when investing in real estate, you have to look at, okay, what type of return am I getting? But if you're a high income earner and you need some tax shelter, what kind of tax benefits can I get from investing in maybe something a little bit larger? Um, would you
Absolutely.
would you say, Sam, that there's any downside to maybe purchasing a commercial unit, or would you say that there's any negatives with maybe purchasing something larger?
I would say it's intimidating. I would say that's the only negative, and that's why I think more people don't do it, and that's why it took me a little bit longer to make the jump. And I was doing a ton of fourplexes, duplexes, homes. I think people get intimidated by the numbers, the high purchase price. I think that's the only negative. And here's an age-old story. You're talking to this seasoned real estate investor, and he'll tell you that he started with duplexes, he started with fourplexes, and typically what he or she will say is, I wish I had never done the duplexes or fourplexes. I'm glad I did because I learned a lot, but I wish I would have jumped straight into big multifamily because there's so many, just like you're saying with tax advantages, there's so many positives and advantages to going bigger. And, like you said, we're going to talk about those.
And I think you're right. I think that it's intimidating because when I bought my 5 unit last year, I mean, I literally went into a little bit of a panic attack. Like I was like, oh my God, like what do I do now? Like the purchase price was $4 million.
Yeah.
And I think it was even the terminology as well too.
Yep.
So there was terminology like debt coverage ratio. There was terminology like PPU, price per unit.
Yep.
There was terminology like just a bunch of different things that I normally wouldn't really think about. And I think like understanding the lingo as well too helped me. So we'll talk about the lingo as well too.
Yeah.
To kind of be able to help people get over that fear. And essentially, maybe you're in a position where you've got $1 million in equity and you pay a lot of money in taxes. Maybe it's in your best interest to exchange it up to like a 40, 50, 100 unit complex somewhere. So I'm excited about that. Now, let's focus more on the commercial side of multi-unit, anything that is 4 unit plus.
Mm-hmm.
So whenever you are doing this type, I know that you said that you can buy it with 30% down, you can buy it with 10% down. Can you finance any of the renovations for a property? Can you do interest only on these types of properties? What does that debt typically look like?
Yeah, man. I mean, there's a million ways to skin the cat. There's multiple investors with different ways of doing things. There's different banks and lenders that will allow you to do different things. So I can only speak from our business model and what we do. I know there are people that do finance renovations. I know there's banks that will allow that. We're ultra conservative. So I would, when people talk about doing commercial, they're intimidated. There's very big numbers involved. And so what we've done to help our investors feel a little bit safer, a little bit more secure, and also for ourselves to know that we're doing the right thing is we're ultra conservative on all aspects. So when we finance a deal, we're putting 25 to 30% down every time. When we find a value add property, we're not financing the renovations because we don't want to add that to our mortgage. We're raising the money. So we could, and potentially we could get a better return because money is cheaper borrowing than it is raising by through your investors like we do, but it's more conservative to have the cash and not owe the bank. We also fund a 6-month reserve account at day one when we close on the property. That's money that we have to give a return on, but we're conservative. So there's lots of ways to finance these deals. There's lots of ways to structure a deal. We have gone the route of being conservative, providing amazing returns and tax benefits for our investors while being as low risk as possible.
And I think that's one of the things that I've learned recently, because up until like recently, I always thought like, man, if I want to buy a $4 million property, I need $1 million to put down.
Yeah.
The thing is that, like you said it perfectly, you said that there's many different ways to structure a deal.
Mm-hmm.
I think the only thing that I want the viewers to understand, the most important thing is finding the deal. Once you find the deal, everything else can be figured out. And that's technically what happened to me. What happened to me is I found the deal, and then I had to figure out how to structure the deal in a way where it makes sense. And one of the things that you talked about is structuring it with raising money. I mean, that's one of the ways. The other way is coming up with a down payment yourself, getting a loan from the bank and having the bank finance some of it. There's different ways of doing it, interest only, principal and interest. So there's a lot of different ways to do it. I would say that the main thing is just finding the right property. and essentially from there, kind of taking it that way. So let's move into that. Like, what should somebody look for when they're looking for the right property? And like, let's say that for whatever reason they live in California and the San Francisco Bay Area, and to buy a 10 unit, it's like $10 million or whatever it is, that prices are too high. Like, let's imagine that somebody is going to have to go out of their area. What would somebody look for in an area when considering maybe buying like a larger apartment complex?
Great question. That's a really good question, because you're right. There's a lot of people that cannot afford to invest where they live, me included. In the last 4 or 5 years, we've had so many investors come to Utah because of the Silicon Slopes and the jobs. It's suppressed or pushed down those cap rates or the returns, and made it very hard for us to find anything that pencils or that makes sense for us to buy. So, that's why on June, I think it's the 5th, we're closing on a $15 million property in Cincinnati.
How much?
What's that?
How much?
15, 1-5. Really cool asset. Really cool. Yeah, we're excited. Number of Mike Ferry agents are in that deal, by the way. But, the principles don't change. So you look at a cap rate, which is good. So you need to understand how to analyze a deal and calculate a cap rate. We use 50% expenses. You can probably operate a deal on less than 50% expenses. So if that's based on gross income. So if gross income's $1 million a year, we know we're going to spend $500,000 on expenses, not including the mortgage. That's just operating expenses. So we'll do a quick and dirty, cap rate calculation if we don't have the numbers from the seller. We know that in order to buy a deal, we need to see, if it's a 5.5 cap based on 50% expenses and based on the price, we know we need to see at least the ability to raise rents 15%, meaning we're going to come in, spend like $5,000 a door, renovate, fix up the place, put in a dog park, make it a lot nicer, but also then we have to be able to raise rents 15%. And then Cincinnati, I think we're going to be around 20 to 25%. We bought that deal at a really, really good deal. We closed one in Dallas last year. We're around 20%. We're doing one in Atlanta right now. We're going to be around 15 to 20%. So that's kind of our quick and easy way to analyze a deal is, as far as the numbers go, can I get a good rent bump? And can I get at least a 5 to 5.5% cap rate in conjunction with that rent bump? Now, the other thing that we look at and we have to have is amenities, a good location with jobs. So if you look at Cincinnati, they have 8 Fortune 500 companies. They're doing really, really well right now. That property that we're closing on in 2 weeks had 97% rent collections for May. Through coronavirus, 97% rent collections because of the high quality employers. While you go to a place that's not Cincinnati, you go to a tertiary market, and they're struggling. They're in the 80 percentile. And guess what? If we were under contract on a deal like that, we wouldn't be able to close in June because lenders don't like that. So we follow jobs. We follow good employers. And we have to have amenities. There has to be a Starbucks within a couple miles. I mean, that's kind of our partner's basic rule. If we have to drive 15, 20 minutes to go get a Starbucks when we're there visiting the property, it's not going to work because renters won't have amenities. So the best amenities you can get in the best location for the best price. That sounds like common sense. But if it's an amazing deal, usually that means you're sacrificing amenities or location, you're in a high crime. So that's just something to remember. You have to have amenities because those help you push rents. Those help increase the value of the property over time. And don't just focus on the numbers or the price.
So just out of curiosity, I've never heard the whole Starbucks thing, and that's kind of new to me. But I think it's kind of like a quick little cheat sheet almost, like kind of like almost like a quick rule of thumb. The way that I would look at having a Starbucks nearby would be that probably Starbucks has already done a lot of research. Probably Starbucks has done a lot of like studies on the demographics, behaviors, and population. And the reason they've gone to that location is because there's something about it. So if you're buying a building near one of those things, if Starbucks is smart enough to go there, you might want to essentially just follow suit on that. So that's like a neat little thing. So like
Yeah.
let's talk about like when you're looking at the population and you're looking for like job opportunities, because this is I read a book called Emerging Real Estate Markets by David Lindahl. And in that
Uh-huh.
book, he talked about that if you follow jobs and you follow population, essentially you're going to determine which markets are growing and which markets are the most opportunistic. So like
Yep.
so like if I wanted to research jobs or research the 8 companies that the Fortune 500 Fortune companies, where would I look for? Where
Just
would I look at it? What websites could I look for to find this type of data?
Google Magic, my friend. It's just Google Magic.
So take
That's
me
all
through.
I do. That's all I do. And you know, there's City Feet. There's all these different websites, but there's so many independent commercial brokers and lenders and different groups that put out studies on different cities that I always Google because I have my go-tos, but I always use Google because there's random studies that someone will do about Cincinnati or about Shreveport, Louisiana, or so I always just Google and it's very easy to find. You just Google Fortune 500 companies in Cincinnati or top employers for Cincinnati or for Boise, for Salt Lake City, and the numbers are out there. Marcus and Millichap does a really good job at putting out research for different locations. CoStar has really good data. You know, they're a data company, and um, it's honestly really easy these days.
Really, because I think that's been my biggest fear. Like,
Mm-hmm.
so I mean, I own 44 units down in Southern California. I know for a fact I don't get great returns as like maybe you or some of the other investors that are investing in Cincinnati or some of these other areas. But the reason I invest here is because I feel safe, meaning
Yeah,
I feel
yeah,
like I really know the marketplace. And I think
yep,
one of the reasons I've held back on going out of state. I see myself eventually doing it, but I just don't. I haven't been able to get over that hump as to okay. Step one, how do I select the right market to be in? And I think that's the part that I was trying to get with you. So you're basically saying take a look at CBRE, take a look at the reports that they pull out as to which. Could I just Google like top 10 markets to buy apartment complexes, or
yeah.
by the time that report comes out, is that too late already?
Well, I mean, we're 5 years too late on the top 10. You
Really?
know, those markets are so hot. You know, Houston, Dallas, Salt Lake City, Boise. Um, it's a hot market nationwide, but there's always going to be deals. And so, if what I found is rather than look at a specific market or look for only one asset type or you know I have to have a 20plex. You don't have to have a fourplex or a 20plex. What you need to do is set some minimum standards for yourself and set the bar for the average income, set the bar for crime. So we know if crime is going up in an area, we won't buy in that location. So crime has to be going down. That means the city is spending money and time working on drug problems and gang violence and crime itself. We don't want to be in a St. Louis or a Yakima, Washington, where crime is on the rise and they can't handle the gang violence. So set some minimum standards for yourself. Set some minimum standards for jobs and job diversity. You can't invest in a one-horse town, but for us, the market's been so hot for so long that rather than define a market that we wanted to be in, or even 10 markets that we wanted to be in, we said we'll go to any market that's over 500,000 people that meets this criteria. So we set our criteria, and so we honestly will go anywhere in the United States that has good landlord laws and that meets our criteria.
Okay, so essentially, just to summarize, minimum population 500,000, not one employer. In other
Mm-hmm.
words, in that it's got like a little bit of diversified. It's not like Detroit that
Right.
that was solely dependent on the car industry.
Yep.
The thing is crime as well too, to make sure that crime is not on the rise. And
Mm-hmm.
essentially, that's pretty much it, right? So how would you find out if crime is on the rise or not? Is that the same thing like
It's measured, man. Yeah, it's Google. You just Google crime in this city, and there's a couple different sites. They
you
measure it, and it's reported. It's public data, so it gets reported and tracked. And we bought our hotel in a city where crime was pretty bad. We knew it was, but that's why I think we bought it at like a 17% cap
know,
rate.
deal?
So there's always exceptions if you're smart about it. But I would say, the other thing to look at is average income. When you're looking at doing these value add deals, you want to make sure you look at people's income, and that's very readily available information. So if I'm going to raise rents on an apartment complex up to $800 a month from $500 a month, but the average income in the area is only X, maybe they can't afford it. Maybe they can't afford it. If their average income is 28,000 a year, they may not be able to afford, even if I make the apartment beautiful, if I do all the renovations that I have planned. So at the end of the day, get educated. And what I've always said is find a partner that's better than you. Find a partner that is more experienced. I work with a guy that's got 20 years experience on me, and he's smarter than me, way more experienced. And I learned from him something from him on every deal we do. We had our roofs blow off of our deal in Dallas. Literally a windstorm blew our roofs off. And after 3 months of negotiating with the insurance company, Robert got us 950,000 more through the claim than they wanted to give us originally. So that was something I would not have known how to tackle. So I would say find a really good partner that knows things that you don't. Maybe they have relationships in the areas that you want to be in. There's lots of good investors out there and lots of good principals doing deals that will bring you on if you can add value, find deals, or raise money.
And that's the thing that like I realized like through this like investing in larger properties that you don't have to do all of it yourself,
You
like
shouldn't.
that's something that like you have people that specialize in, like you could be the money guy, somebody else could be the boots on the ground type of guy, like your friend Robert. I mean, he was able to he already had that background and that experience, and I think that's one of the mistakes that I see people make sometimes, is that they want the whole pie, but because they want the whole pie, essentially they miss out on opportunities,
Mm-hmm.
or they put themselves in situations where they've ran the property to the ground and now the property's not worth very much. And I think what you said in regards to population, I think that's really important. I saw a property on the MLS in my area, not my area, but like some little town that I had never heard of in San Bernardino County. It was
Mm-hmm.
$5,000 a door, and I was like, "Oh my god,
Nice.
$5,000 a door!" But then I googled population in this town, and it said 1,700 people.
Oh
And
wow.
like, oh my god, probably even though the price per unit is really low, you'll probably have trouble renting it. There's just
Right.
not enough people in that town. So I think that's really important is well too. So who are the main? So here's a question. So Grant Cardone says you should invest in 16 unit plus. Why 16 units for those that don't know 16 unit rule?
So economies of scale and mitigating your risk. That's the answer. And it's very, very important that you understand what happened in the 2008 recession. So I have a podcast called Recession Proof Real Estate Investing. And for the past 4 or 5 years, I've been studying what happened in 2008. So what Grant Cardone says is buy something that is scalable. If you have one renter move out, or two renters move out, or three or four lose their jobs because of coronavirus, you still have 12, 13, 14 renters paying rent. If you have a duplex and one of your renters moves out, 50% of your income's gone. You have a fourplex and two of your renters lose their jobs, 50% of your income's gone. And all of a sudden you're covering those expenses. So here's a crazy number for you, and I want this to soak in. Here's why we only do big deals. We can afford to have 25 to 30% of our renters not pay rent on any given month, and all of our expenses will still be covered.
Wow.
You can't do that in a duplex or a fourplex. You can't do that. Honestly, you may not be able to do that in a 16plex, but you can get a lot closer. So in the 2008 recession, average vacancy jumped, or gross income on average dropped by about 15%. So vacancy went up, average rents went down a little bit, and investors all of a sudden were like, holy cow, this fourplex that I bought no longer covers my expenses. And so the more amount of units you have, that risk and that drop in income is spread out over quite a few more units, and it's easier to weather that kind of a storm. And so that's why you didn't see the amount of foreclosures on big properties as you did on single family homes, duplexes, and fourplexes. I would argue it's also because those investors are more educated and a little bit more conservative, because the banks will force you to be on those bigger deals. But yeah, it's scalability. It's just scalability, and the ability to weather a storm is so much better on a large property. Actually, our Cincinnati deal, we can be 33% vacant and still cover all our expenses.
One of the things that I was going to elaborate on the 16-unit part is I think that a lot of people don't realize how much of a help it is. But in California, when you have over 16 units, it requires an on-site manager. And I think that's one of the differences as well, too, that maybe a lot of people don't realize. Because, like, if I had to select between managing fourplexes in different locations, or one fourplex or one 16plex in one location, I would pick the 16plex all day.
Absolutely.
I can't tell how much of a help it is to have an on-site manager. Like, if we have a property that goes vacant, our on-site manager is ready to show the property. Nobody from our office has to go leave the office to go show the property to one single person. So it makes everything a lot more efficient. As well, too, if you get everything like that, 16 units are under one roof. Like, if you ever have to change a roof, you don't have to change 4 different roofs. You can just change. And I think that's what you were referring to in regards to the economies of scale. So let me ask you this, Sam. What markets are you in right now? I know that you talked about being in Cincinnati. I know that you're in New Mexico for the hotel. What other markets are you in right now? And what other markets? I know that you kind of keep it pretty wide, but what other markets have you heard are you personally in, and what markets would you like to be in? Not like the markets that are already like 10 years old that, I mean, often would miss the opportunity if they're looking for a good value add, but maybe something that you'd say that is up and coming.
Yeah, I mean, I love to be in Boise and Salt Lake, but I'm not finding anything to buy there. I just developed a fourplex community in Boise, and it was fun, but yeah, it's hard to afford something there. So we're looking in Tampa. You can still find good deals in St. Petersburg, Tampa Bay area. We were under contract before coronavirus hit, and we had to drop that deal because lenders lost their minds there for a minute. Hopefully we'll put it back under contract when they calm down. Cincinnati, I love Cincinnati. The people are kind of like Idaho people. Like, they're just so nice, down to earth people. I love it out there. Cleveland, I mean, they make cotton, so they're making all the coronavirus tests. They're doing really well right now. But even before that, they were doing great. Indianapolis. So Midwest, if it's a Midwest city that has a large population, has a growing population, and has some good jobs, we're interested. Atlanta has Delta Airlines, which, that may be a little bit not the best right now because of coronavirus, but Delta's not going anywhere, and they're going to bounce back. And we're closing on an Atlanta deal here in July that we're in love with. Albuquerque, New Mexico is a great market. We have a property manager that we absolutely love, and we're looking really hard in Albuquerque, and we're always looking in Texas. So honestly, Midwest, East Coast, as long as it's a landlord-friendly state. And I would look anywhere that Tesla or Amazon is announcing. Cincinnati has the $1.5 billion Amazon Air Hub being built right now. So anywhere where tech jobs or big time employers are going, we're looking in.
That's awesome. Now, you mentioned one thing that is really important, and I think this is the reason why some people are getting out of California, and it has to do with the landlord-friendly laws. I know that certain states that look out more for the tenant, there's certain states that look out more for the landlord. What do you mean by that, by landlord tenant versus tenant friendly? And yeah, what do you mean?
Really good question. So I have a story from an investor, and they had a renter not pay for 3 months, so they decided to evict them. They're in California, and they went to the judge, and the judge said, okay, so you're evicting this person. What's the reason you're evicting them? And my investor said, well, they haven't paid rent in 3 months. I know they still have a job. They just decided not to pay rent. They're not going through hardship. And the judge said, yeah, but why are you evicting them? What's the reason you're evicting them? And my investor said, no, they haven't paid rent. That's why I'm evicting them. And the judge said, no, you have to have a reason to evict them. And so that whole logic doesn't work for me and my investors. If someone has hardship, we will always work with people, because at the end of the day, people live in our properties, and we want to take care of our residents. We will work with you. But if you're not just paying rent, or if you're just not, you decided not to pay rent, we need to be able to evict you and get someone in there that will pay rent, because it's a business. This isn't a charity. And so in Utah, I think it's a 3-week eviction process. If they haven't paid rent and they're not going through some type of crazy hardship where we need to help them out, then they're out in 3 weeks. And so that's a landlord-friendly state or location versus parts of California or Chicago or New York or somewhere else where you literally, even if they're not paying rent, you can't evict them.
Yeah, well, it has to do with, I think, the time that it takes to get somebody out that's not paying rent, essentially.
Like months or even years in some places.
Yeah, in some places it is. Okay, so that's also important when deciding where to invest in, and knowing that is a risk. And I mean, there's some states that have implied like rent control and different metrics as well too, that limit the amount of rent that a landlord can increase. And obviously there's pros and cons.
What's interesting on that is I don't think that's had as big of an effect as
a little bit far.
Eviction law. Yeah, so I have these investors, they came to me with $80 million recently, and they said,
you sound a little far, Sam. You sound a little farther.
Can you hear me now?
Better.
Sorry, my thumb was over my mic. So I had investors come to me recently from Oregon, where rent control was just instituted last year. And they said, honestly, Sam, we're not worried about rent control. We're just tired of not being able to evict people when they're working the system. They know we can't evict them, so they just don't pay rent. But I probably wouldn't buy somewhere with rent control either.
Yeah, cool. So now that we've kind of talked about how do you select an area, let's talk about like the actual property itself. Let's talk about I know that we talked about cap rate. I know that there's other metrics like the net operating income. So let's talk about some of those metrics when analyzing a deal. So let's start off with this. So I want to make an offer on a property, and I want to obviously decide what to offer for that property. What type of document should I be asking the seller to provide to me so that I can decide, or I can base my offer?
Analyze it, right?
And here's another thing that I want to clarify is one of the big differences that we haven't talked about residential and commercial. In residential 1 to 4, the property's value is based on the comparable sales, meaning what other fourplex, triplex, duplex have sold in the area. The difference in commercial real estate, and the reason a lot of investors like the commercial real estate, is that it's based on the net operating income, meaning the profit that the building produces. So essentially, in a residential market, you have to wait for the comps to go up for your value to go up. In a commercial building, you can go in there, make some changes, improve the revenues by adding things like laundry units or things that improve the profit, decrease the expenses. Now your profit goes up. Now the value of the building goes up. So I think that's the things that people are most attracted to. So let's talk about what types of documents we would ask for, and then we can dig into like cap rate, net operating income, and what some of those metrics mean for the consumers out there.
Perfect. So the first thing I do is I get on apartments.com. So before you even ask a seller for any documents, I'm going to go to Google Earth, and I'm going to look on Google Earth, Google Street View, and I want to know, is this a place where I can attract a good type of renter? What is my renter demographic? So that's actually the first thing I analyze. So I was just sent a deal in Albuquerque. I think it was 30 units, but it was literally a parking lot.
Live again. So you were talking about one of the first things that you do whenever you're analyzing, you go on apartments.com. You said that you had a property that was sent to you in New Mexico or Albuquerque?
In Albuquerque, yeah. And all it really was a parking lot. There was no ability to add amenities. And so that's one thing, you know, that really pushed us to go to bigger and bigger and bigger properties because of the value add aspect. So if I own a townhome by itself or an apartment complex, a small one by itself, and there's no ability to have a dog park or a park close by or a kid's playground, that's really, really tough. I think you were on your units. Congrats on buying that, by the way. You were going to add a kid's playground, right?
Yeah, I'm still considering that. Right now, the value add that we're considering doing is that, and this is what we're talking about, just for the consumers that are listening, we're talking about ways to increase the revenue for the building. One of the ways that I'm going to do is there's a potential for me to add 6 additional units to the property.
Oh, nice.
Essentially, which would increase the revenue for the profit, which would increase the NOI, which would then increase the value of the building. And that's what I like about it, that I don't have to wait and see what the marketplace does. I don't have to wait if my neighbor sells at a certain price. I just have to manage the property like I manage a business, increase revenue, decrease expenses, and essentially that makes the building worth more. So this property in Albuquerque didn't have, it was just an empty parking lot. So you didn't have the ability to add additional amenities. Hence, you couldn't, the ability for you to increase rent was limited because you're not providing additional value. And it sounded like maybe like the rents were already at market value or something like that.
Well, they were still pretty low because it needed to be rehabbed inside. But here's what I always do. I look and I say, okay, what kind of renter profile am I going to attract? If I'm going to put 5, 6, 7 grand per unit into this complex, but I'm just going to attract low income people who traditionally don't treat them very well, is it worth it? Or should I spend my money and my time buying an apartment complex where I can have a pool, a clubhouse, I can update the units and attract a better renter profile that's going to stay longer, be less of a hassle, and treat the units better. And so when Grant Cardone and all these big time players say that you should never buy smaller units, that's what they're talking about. And so now in Utah, I sell basically one type of investment property. It's a townhome that's in an HOA. So in Utah, I only want to own small rental properties if they are in an HOA and if that HOA includes a pool, a clubhouse, a workout center, and playgrounds. Because I know that if rents go down and I have to compete with other townhomes and rental properties, I have the amenities and I have the advantage. And I'm going to be rented out while others are not, because those are huge attractors for a good renter demographic and renter profile. So you asked about what kind of documents do I ask for? Well, that's the first thing I do is I do the rent comps and I look at apartments.com and Google Earth, and then I ask the seller for their rent roll. And I'm going to compare it with what I think I can do once I've rehabbed the units. You know, can I get the rent up to $750 if they're at $650 right now? And it only needs paint and carpet and a facelift, then yeah, that sounds like a pretty good deal.
So pretty much the rent roll, that's the first document. After you've done a little bit of due diligence, kind of looked at it on paper, first document is, can I get a copy of the rent roll?
And let's back up a second. I'm only asking for the rent roll once after I've done my quick and easy cap rate calculation and looked at the rent comps. So if I know their average rents, I'll even just call the property manager and act like I'm a renter and say, hey, what are your rents? They tell me they're $650. I'm not even going to look at their rent roll or their T12. We'll talk about that in a sec, until I've done the rent comps and I know for sure there's a value add play even there. So once I know there's a value add play there, then I'm going to look at his expenses. So a T12 is a trailing 12 financial statement. If they have a bookkeeper or if they're a good property owner, they should track all of their expenses with some type of software. Hopefully you get it in the form of an Excel. Most of the time it's in a PDF, which is annoying, but there's still ways to convert that to Excel. And then I throw that into my analyzer and I compare what their current and last 12-month, last 3-month expenses are versus how I think I would run the property. And then I plug in the rent bumps, and I know if it's a deal that I want to make an offer on.
Okay. So basically, you do a little bit of research, and you can even call the management company to see what the rents are, and then you can kind of base your numbers on that. And just and just for a very quick calculation of like, okay, like I just want to know like whether we're even in the ballpark. So like, let's say you take the rent roll of how much their rents are on a monthly basis.
Mm-hmm.
You would multiply that by 12.
Mm-hmm.
And then factor in the expense ratio, which I think you guys are conservative. So you guys are going
50%.
At about 10%. So like, let's say that the gross rents on a year are 200,000. Now you factor 50. Now you've got 100. That 100,000 is the NOI, the net operating income, right? For the property. And that's the number that determines the NOI. The cap rate, essentially. So
so you divide that by the price.
Gives you the purchase price, the price, the value of the building.
Yeah, so you can work it both ways. Once you have the net operating income number, that 100,000, and they say, hey, just make us an offer. Well, I know that I'm probably only going to be able to get a 15% rent bump based on my business plan and the rent comps. So I know I'm probably going to only be able to pay a 5.5% cap rate. So you can divide that 100,000 by 0.055, and that's your offer amount. Or vice versa, if they know they want $2 million and I know my NOI, then I can divide the NOI by the 2 million, and that gives me what cap rate that property would be at offer amount or a purchase price of $2 million. So that's pretty quick and easy. And that's a really good way to look at units. Now, smaller duplexes and fourplexes, I actually use a ratio of 35 to 40%. If it's a really old property, I use an expense ratio of 40%. If it's a newer property within the last 1 to 2 years, I use 30%. If it's 10, 15 years old but looks pretty good, I use 30, 35%. So it can change for sure. But yeah, that's so look at your T12, do the cap rate, and you really should have an analysis software. So you can do it through an Excel. I actually paid for mine through David Topin. He's just a whiz kid that put together a really good analysis software. I think Michael Blanc has a really good software as well. But you really shouldn't be using the software unless you know it's probably a pretty good deal that you want to do.
That's awesome. So essentially, what is a cap rate?
Very simple. It's your expenses, your yearly expenses taken away from your income. So you have your income, take out your expenses, and then whatever money's left over, you compare that to the price. So my net revenue for the year, or my net income for the year, compared to the price that they're asking, that gives me a cap rate. And it's just a way of analyzing a return. And now that's not including your mortgage. So some investors may put 25% down, some may put 50% down. So cap rate was created to help people analyze the price and income of a property, not including a mortgage.
So this is what I've heard, and I don't know if this is right or wrong. Does the cap rate have anything to do, like if you purchase this property for cash? Meaning, like if I purchase this property for cash, this is the return that I would get on my cash based on this purchase price.
Mm-hmm. Yeah, so it's not assuming financing, and yeah, you can look at it as cash, or basically you're just not thinking
Your
about the
return
way you're
itself,
buying it.
yeah.
It's just income versus price.
It just, yeah, basically what income does the property produce at this price, and that gives you the cap rate. So let's
Right.
talk a little bit about expenses. I know that you said that about 50% you can account for in terms of expenses when managing a big building. Is there some areas where you account for higher than a 50%, or is that like pretty conservative at all? And is there some areas where you can go maybe like a 30%, or is that like too optimistic? Like just for whenever people are doing the calculation. And what would these types of expenses be as well too? Because when I would hear 30-40% expenses, like when I first started learning about commercial real estate, I would ask myself, I'm like, man, where is all this money going? But I didn't realize that taxes and insurance were part of the expenses as well
Right.
too. I was thinking in my head like 30-40%. I'm like, I have rentals. I don't spend that much money on the
Right.
rent, you know? So is there a way, like what would be a too of an optimistic number for a larger building? And what is like super conservative in terms of expense ratio? And how do you determine that? Does it vary by market? Does it vary by location, size, year built?
Yeah, mostly it's going to vary by size, and that's one attractive feature of smaller units is you can self-manage. So I self-manage the 4 townhomes that are within 5 minutes of my house because literally they're brand new. They're in an HOA that does all the exterior maintenance, and all I do is once a year or every 2 years, I find a new renter for them, and it takes me one day of work, and I save myself, 8% off the rents. So my expenses drop by 8% by self managing. So that's one advantage that you have on those smaller complexes is they're the size where you could probably actually self manage and save yourself 6 to 8% off of of the property management fees. Um, but I would say the only way you're going to be in the 30% range for the larger facilities is if you self-manage. So, but it's really not that, because if you pay yourself any money, people say, well, my expenses are 35% because I manage it myself. I'm like, well, okay, but you're taking revenue out of the property. So in reality, you're over 40% anyways, just a different way of looking at it. So I've never found a large multifamily property that could be run under like 42% expenses. If it is, that usually means that they're not repairing stuff that they should be. They're not spending money on water heaters, roofs, dishwashers. And so that's something to be wary of. And that's actually a red flag that may say, hey, I can maybe get a good deal on this because there's a bunch of deferred maintenance and I can beat the seller up on the price because they know they haven't spent a dime repairing this thing in the last 10 years. So if they're telling you they're operating at 30, 35, 40% expense ratio, that's the first thing I think. Now, there are locations where if you have a killer property manager and a killer on-site manager, maybe you're full all the time, you have one really, really good maintenance guy, yeah, maybe you can be in the 42 to 45% range. But with these larger complexes, it's very rare because good help is hard to find. Because taxes are going up, that's your biggest expense usually is taxes. And so like the Cincinnati deal, we have to have 2 or 3 people on site full time just to show the units. It's a middle income area and there's going to be higher turnover. So we know we're not going to be much under 50%. But let's talk about the types of things that are on that expense sheet. So number one is property taxes. Number two, the most important thing is to have a really good on-site manager and an on-site maintenance person. You're going to have to pay them good money because it's a hot job market. So expenses right now are going to be higher than they would be in a recession. If the recession comes, we'll be jumping for joy because we'll probably be operating at 42 to 43% expense ratio because we'll be able to afford to pay a lot less for repairs and pay a lot less for the people that work for us because that's just the nature of a recession and a job market like that. So snow removal, in Utah and Cincinnati and these places with snow, you have a lot of landscaping every spring and every fall, and then all winter long you have snow removal. If there's a pool in a clubhouse, you have to keep the place nice. Tree removal is huge. So we were analyzing a deal in Boise recently with Michael Young, actually. He was out there with me. And there was, I would say about 80 trees on site that were all 30 to 40 feet tall with branches going all over the place. And so if you're looking at a deal, you better budget a couple thousand a year per tree to have those things trimmed the first year that you own it. And, it's going to be an ongoing expense. So landscaping and maintaining the property is very nice, but I'd say the highest expense typically is going to be your property manager, taxes, and then just turning the units over every time you have someone move out, getting them back into good shape. Of course, you got to maintain all the systems, but turnover is a very big expense as well.
Yeah, I think you said one important thing when you were talking about the expenses. You said that if somebody is saying that they're operating their property at a 35% ratio, it might be a red flag. And just know that if the property has a lot of deferred maintenance because they haven't been investing in the water heaters, they haven't been keeping up with the termites, they haven't been keeping up with some of the other things, that just means that when you buy the property, essentially those are things that have accumulated and that you may have to fix. So you want to be able to factor all those things in as well too.
Called deferred maintenance, and that's how we got a great deal on our hotel. They hadn't spent a dime in 10 years and they sold it to us for over $3 million less than what they bought it for. And they probably, the crazy thing is I see blood in the water. When I see someone operating a very, very lean property or they're not spending money, I see blood in the water because that scares buyers off. And it's going to be harder for them to sell that property because there's so many expenses. I love that. That's the type of property I look for because either I'm not going to buy it or I'm going to get a really, really good deal on it. Those are the only two options. I'm not going to pay top dollar for a property that has all this deferred maintenance. So I get excited when I see those expense sheets.
Right. So we talked about cap rate, basically it doesn't factor in finance. The cap rate, basically just if you were buying this property in cash, what would the return be at that purchase price? We talked about NOI, that's basically the profit. It doesn't take debt into consideration. You don't factor in the debt either for the net operating income. We talked about expenses. What about like a price per unit? What do you ever look at the price per unit when you're buying properties?
All the time.
Say is like a price per unit to rent ratio that you typically like to stay in, meaning like if the market rents are $700 a month, are you looking for a certain type of price per unit that would make it more likely for us to be able to get a good deal on a property?
Yeah, there's two. I mean, these are kind of rules of thumb that don't always apply, but are good to look at. So yeah, price per unit, we always look at. And if you're going to be buying in a location, you should know what properties are trading at. So in Salt Lake City, we're at like 135,000 a door, which is why I'm not buying anything in Salt Lake City. Cincinnati.
Before you move on, what would the rents be at 135,000 a door? Like, what would the rents for the unit roughly be?
Yeah, so that's one of my rules of thumb. We want to be, if you go 700 a month, what is that per year? That's 8,400 a year. So we want to be at least 3 times that or be able to 3x that to get our price per door. So or more. So at least 3. So in Salt Lake City, you're getting, geez, I don't know, for 130,000 a door, you're probably only getting 900, and the 900 a month, 900 to 1,200 a month. So you're paying a lot more per door for not that much rent per year. Mm-hmm. And the same thing goes for house prices. So if I'm paying 40,000 a unit, I think we're right around 43,000 a door in Cincinnati, but average home prices in that location are 150 to 180,000. That's actually really, really good. But if you go to Memphis, Tennessee, and you're buying at 43,000 a door, but you can buy a house for 60,000, for 60,000 bucks or 80,000 bucks, that scares me. Because a renter could just move out and go get a mortgage for cheaper than it would cost them to rent my unit. So average home prices, you typically want to see at least 3x or 3 times your per door price.
That's a pretty good rule of thumb right there. So like if essentially, because I mean that makes sense that if your price per door is 43, but they can go buy a house for 60, it's kind of like why would I?
It's not good
here but in comparison to like Utah at 130 a door, the median home price is probably like 300 or
330.
Yeah. So that's a lot better. It's a lot less likely for somebody to be able to make that jump right away.
Right.
It increases the tenant pool.
Yeah. So we're about double in Utah what you can buy a unit for, but in Cincinnati we're over triple. So that makes us even happier. That makes us really excited and feel a little bit safer, more secure.
What is the price per unit in Cincinnati?
I think we're right around 43, and the average home price in that area is about 160 to 180. So we're actually, we're doing well.
4 times that number, essentially. Okay, that's cool. What about the DCR? I know that briefly we talked about that at the very beginning. I know when I first heard the term DCR, I was like, man, what is this? And like, I think the scariest part for people is once you start jumping into this league is really understanding the lingo. And like the person that you see here today, Sam, it's completely different than a year and a half ago.
I bet.
A year and a half ago, you could have said PPU, DCR, cap rate, NOI, and I would have been like, slow down,
Yeah. Well, that's one reason my partner always asks me, hey, I see this mixed use building. Let's take a look. I don't even look at mixed use buildings anymore because I know a lender is going to underwrite it not based on the DCR for a multifamily. They're going to underwrite it based on the DCR that they need for a commercial building, which is higher typically. So debt coverage ratio is just how much rent is coming in to cover the mortgage payment. And they typically want a minimum of 1.25. So, 1.25 times the total mortgage payment is how much rent is coming in. In Cincinnati, we're at about 2x. So it's a very conservative deal. The higher the ratio, the better and the more wiggle room you have as an operator.
The less likely of default too. So essentially what he's trying to say is, let's say that the mortgage is $1,000. They want to be able to see at least $1,250 coming in a month in rent, which that's a 1.25. Now let's say it's a 1.5 DCR debt coverage ratio. That would mean $1,000 payment. That would be $1,500. Now when we talk about payment, is that principal, interest, taxes, and insurance, or is that just principal and interest?
Depends on the lender. I mean, different lenders will underwrite differently. But yeah, typically, they're going to look at your expenses and they're going to look at your mortgage and look at everything.
So it'd be the whole bundle in other words. Okay, cool. How do you know when you or where do you look for good deals? Like, are there certain like lead sources Like, do I like build relationships with brokers?
Yes.
Do I talk with owners directly? What would you say would be like if I was looking for a good opportunity? What would you say the best way for me to put myself in a position to be able to find that is?
I would say all of the above. I would say you want to network and become friends with property owners and investors in your area. You want to join clubs and hang out where other investors hang out, but also call brokers. So the way that we found the Cincinnati deals, we just happened to have been talking to that broker the month before. We happened to call him again and just stay in touch with him the day that he listed that property. And it was us and one other buyer. Instead of going to market and getting multiple offers, it was just us and one other buyer. Same way I've got the other Cincinnati deal I'm working on with Michael Young. When I was out there last, I visited every single broker I possibly could and said, hey, we've got X amount of $1 million lined up, ready to go for a deal. We're serious buyers. And, here's a little bit about us. I recorded videos of Michael Young and myself and a couple of our other partners talking about what we're looking for. And I sent those out to multiple brokers. And I'm also scrubbing lists of property owners and cold calling them. So I would say do all of the above. If I had to pick one and say which one, if I could only do one activity to find deals, I would say it would be calling brokers.
Really? Yeah. And the thing is that a lot of the commercial brokers are going to find the deals maybe before you do. And maybe they already had that relationship with the seller that wants to sell. And maybe you might not find the right info for that seller. The other thing is that I'd say that a lot of the commercial deals sometimes don't even come on the market, right?
Right.
Some of the commercial deals are never listed. So essentially you definitely want to develop relationships with brokers
with the listing broker,
because if you do that, essentially you could put yourself in a position where you're getting something before it comes on the marketplace. They say, and I don't know if this is true, they say that by the time it goes on LoopNet or CoStar, it's already been shopped around to the buyers.
I was just about to say that.
Passed up on it. So that's just a little hint for the people that you want to try to build relationships with multiple brokers and let them know that you're serious, be qualified, have the money in line, have the financing in line. And essentially, if you say you're going to do something, do it. The other thing is that you don't want to burn your bridges, meaning if you say you're going to do something, do it, because word will get around if you don't perform or if you don't do something that you said you're going to do. And here's the other thing, that when you perform, this broker is going to gain confidence, and this broker is going to bring you more opportunities. He's going to be like, Sam is a straight up guy. Sam did everything that he said he was going to do. My next deal is going to Sam because Sam was easy to work with, and I want to work with Sam again. And maybe the first deal is not a great opportunity, but maybe the second or the third one is like a slam dunk type of deal that you can get because of your relationship with the broker. So let's say that.
Absolutely.
So let's say that you're analyzing the deal, Sam, and you ask the seller for the rent roll and you ask them for the T12, and they're like a mom and pop shop type of person. They collect rents in cash. How would you go about doing your due diligence and making sure that that they're collecting a certain amount of rent, or what do you do in these types of situations?
So that's tough. I mean, at that point, honestly, we're going to trash the deal unless it's a really good deal, because if it's a marginal good deal or something that's barely good enough for us to look at and we can't get numbers on it, we don't know the type of condition, what kind of leases they have, it's probably not worth your time. But let's say that they're willing to sell at a good price. Let's just assume that it's a good deal that you want to pursue. Number one, if they're self-managing, then you just ask them for a copy of their leases. If they don't even have a copy of leases, that's not good. If you can, I would have someone go and honestly just knock doors and verify in person what the rents are. And so we're probably talking about small units in this scenario. That's probably a 4 to 16 to 20 unit building. There's not a lot of mom and pops that don't have any type of rent roll. But if that is the case, you need boots on the ground and you need some way of verifying at least what the leases are. And that's all I really need, is to know what they're currently being leased for, and maybe a quick peek in the door to say, what kind of condition is this in? Because if I can't get any info out of the seller at all, there's no photos online, there's no apartments.com, advertising, then I really don't have much to go off, and my assumptions may be totally off. So you need to get some type of boots on the ground and some type of verification. Honestly, what I do all the time is I will pretend like I'm a potential renter. I'll knock on one of the renters' door and say, "Hey, how much are you paying? I really like this location, and do you know if there's any vacant units?" And they'll say, "Oh yeah, there's 5 vacant units. The owners are the worst. They won't fix anything." So they'll spill beans all the time. And I just did it here in Salt Lake City, and we found out that the sellers were saying they had fixed certain things that they hadn't, and so we actually just had that on a 32 unit complex here in Salt Lake. We didn't buy it, but boots on the ground, man, that's the answer. You've got to find out. You've got to be creative and figure out the numbers some way.
Figure them out. Cool. Now, I know that I've seen your very fancy spreadsheet, and
very nerdy.
Well, I think it's a good thing. And obviously there's a lot of different numbers that go into it. For example, like the rents. What is a pro forma? Meaning that what is that, and how do you kind of base your pro forma based on? Do you base your pro forma on whatever the listing agent tells you, or do you do your own pro forma?
Oh, of course, they're always 100% accurate.
So what is a pro forma, just to start off?
So I'm a listing agent, so I'm allowed to make fun of us commercial listing agents. My job as a listing agent is to make the property look as sexy as possible. Mm-hmm. So without being dishonest, I'm going to add that caveat in there. There are dishonest brokers, but so let's say you have a good broker, he's representing the seller. He's going to give you best case scenarios on expenses and best case scenarios on rents. We underwrite for worst case scenario and average, not best, because almost nothing ever works out best case scenario. And that's just not the way you want to underwrite. So a pro forma is what an investor or a broker puts together to say, here's the features and amenities about this property, here's the expenses, here's the potential income, and here's how you can expect this property to perform financially over the next 12 months or over the next 12 years. They're projecting what it should do, maybe based on past performance, but maybe not. Maybe it's just a projection.
Okay, cool. And then on your pro forma, I mean, obviously you put in maybe like rent increases, potential rent increases. Maybe you factor in like a little bit of inflation, like maybe like rent increases due to inflation. What else do you factor in? Do you factor in like more long-term maintenance, like for example, like roof, plumbing, electrical, that sort of thing as well too?
Absolutely, yeah. So when you look at our Excel spreadsheet, our analyzing tool, you'll see a spot in the pro forma where we have those expenses line itemed. So every expense has a line item, and every line item increases every year by 2 to 3%. Now, rents in Utah have increased by 5 to 10% for the last few years. Still, when we underwrite, and that's the same for a lot of other locations, we still only have on our pro forma rent increasing by 2 to 3% to be conservative. So we're going to stick with 50% expenses for the life of the property. We're going to have a few assumptions like rent and expenses going up year over year a little bit. We're going to look at our business plan as far as remodeling the units. How much can we actually get in a year one rent increase? If we think we can get 200, we're going to put 150. We're going to try to be conservative on that, knowing that if we do better, it's a pleasant surprise. And so our pro formas, that's why we look at 150 opportunities to buy one. We're ultra conservative because we're only going to buy something if it's a home run. Warren Buffett's number one rule is never, ever, ever lose money. And I've never made less than a 20% return on my own investments. And it's not even that I don't want to lose money. I don't even want to buy a deal that's not a great return. Life is too short to have crappy real estate deals. And so we're ultra conservative on those pro formas. And we have to get our investors at least a 6% cash on cash return and at least a 15% return on investment year over year.
Okay, great. So let's talk about the NOI. So let's talk about ways to improve the profit of the building, the net operating income. What would be different ways to improve the revenue that the building produces, and then we'll jump into what would be different ways of reducing the expenses to hence improve the profit.
Well, number one is your property manager. So that is either going to make you or break you as a property owner. You have to have a really good property manager, and they have to have good employees. So when you call, I would secret shop your facility, and I would make sure that they're answering phone calls, because one of the biggest losses in revenue is lost opportunity to rent and having vacancy. So a good property manager will make you a lot of money, and that increases your bottom line by quite a bit. So I would consistently and monthly secret shop your facility, your apartment complex, and make sure that they're answering the phone, they're getting back to potential renters, they're professional, happy, and doing a good job on that. After that, I would look at your expenses. And one of the property managers we really like in Albuquerque, he has a software that he built himself that makes his property manager verify through photos daily of whatever they're working on. And so you reduce time to repair things, you reduce time to turn over different units that have been moved out of. And just being a more efficient property owner and property management company, or helping the property management company be more efficient, will save you a lot of money. Because if a maintenance guy is left on his own, he's probably going to turn over a unit in a few days rather than in 1 8-hour workday. So then you're paying way more for your hourly wages or different things than you could be. So a creative way that I thought was really cool is my buddy hired an assistant to his leasing agent to be just a personal investigator, a private investigator. And she became a spy on the property, and she spied on the tenants and watched which unit they would come out of, when they would let their dogs go to the bathroom, which unit they'd go back into, and then she'd go back and look at the lease and figure out if they paid a pet deposit and if they were paying pet rent. And over 50% of the people that had pets had not paid a deposit and were not paying pet rent. We love pets. We want our people to have pets, but we just want them to be able to pay a deposit and pay for rent pets. So he increased his NOI by a huge amount by having that personal or private investigator on site following people around that had pets, and really did a good job there. Trying to think what we've done. Dog parks, playgrounds. I mean, amenities will attract a much better tenant profile, and in turn, you'll be able to raise rents. And they're not that expensive. So there's things you can do to make the property a lot nicer. As far as saving money, RUBS. RUBS is huge. For those of you that don't know what RUBS are, basically, a lot of the larger properties, the owner will pay for the water, the gas, the sewer, and that's just, there's no separate meters, so they have to pay it. But what a lot of cities will allow you to do now is charge the tenant an average bill every month. So maybe your gas bill and all of your utilities are $80 a month. Well, you're going to charge every single renter $40 a month for their own utilities. And if everyone else in the area is doing it and you're not, that's a great way to increase revenue. And it's amazing how many property owners aren't taking advantage of RUBS, and they really should be.
So one of the things that I've heard, and I think people should watch out for, is when analyzing. Let me ask you, would this show up on the T12? Like, let's say that I had a contract with a cell phone tower, that they put a cell phone tower on my building, and I received a lump sum, which makes my revenue go up for that year, and maybe the NOI higher for that year. So obviously that's something that we can't count on moving forward because that was a one
Right.
payment or whatever. I've heard of that obviously affecting the NOI, and that's why it's important to look at the T12 because they may not be lying to you. Yeah, we grossed or our NOI was 300,000 this year, but what they're not disclosing to you. Awesome. So one of the things, Sam, that we were talking about is we talked about the satellite thing about how like that
Yeah.
additional revenue can impact the NOI for that year. So that's why it's important to look at the T12. Now, one of the things that I wanted to ask is, besides the T12, do you go back further and ask for like maybe like 2 years, 3 years, or is it only the trailing 12? Do you want to see like, okay, is this property improving? Is it not improving? How would you
Sure.
do that?
Yeah, I mean, we want as much information as we can get because we're nerdy and we love crunching the numbers. And absolutely, you're just not going to get that typically. So on every T12, you're going to have a line item that's other income. If you're lucky, it'll be broken down. Other income will have, sub line items that will say satellite tower was put on, and or we have a satellite tower lease, or there's laundry units and there's a company that actually leases the laundry space from us, and we just get revenue from that laundry space. Or let's see, what's another one? In the hotel we have, there's a restaurant that we lease. We don't run it ourselves. There's a dance hall. So yeah, in any T12, you need to be able to look at the average rents. And if the gross revenue, the gross income does not add up to just the rents, you need to figure out where that other income is coming from. I've seen where they'll count a huge amount of money on the T12, a huge amount of income from past due rents that they've collected from past years. So if you count that as income on your pro forma, that's going to be way off because you can't always count on collecting past due income, and it's not good to have that on your pro forma. So that's a really interesting thing that sellers will try to do. They'll say, okay, team, let's crush it. We're going to sell the property. Let's crush it. Let's let anybody rent the property that wants to rent it. We'll bump up the gross income, and let's go crazy with collections and bump up that NOI by increasing collections as well. So that's something to look for.
That's so interesting, man, and that's so good that you say that because essentially somebody may look at the NOI and be like, "Man, I'm getting a smoking deal. I'm getting an
Yep.
8 cap or I'm getting a 7 cap," but the reality is that they're getting a 4 cap and everything
Yeah.
else is beefed up. You know?
Yep. Or they're getting a property with a bunch of tenants that weren't screened, and they're just going to move out a month or not pay rent a month after they buy the place.
Okay, good. So let's jump into due diligence. Like, let's say that you happen to open up escrow on this property and you
Mm-hmm.
start doing your inspections on the property. What type of inspections do you typically do? How much time do you ask for an inspection period? Do you guys do appraisals? And do you guys have a loan contingency? And lastly, how do the contingencies work? I hear a term called going hard. After a certain amount of time, it goes hard. I know
Yeah.
that's applicable for residential, but let's touch on some
Yeah.
of
So it depends on the location and how hot that area is. And I always ask the broker, and I ask the broker to ask the seller what they're looking for on due diligence time period, on earnest money, on how soon the earnest money goes non-refundable. In Cincinnati, we were like, hey, we're going to do X, Y, and Z. And the broker's like, why would you do that? That's way too aggressive. So we're like, okay, well, tell us what we need to do. Because we're used to Utah. I mean, there's people in Utah, they'll go $1 million non-refundable day one.
deposit. Wow.
No due diligence. Because they're these hedge funds or family offices that know that they don't really care what the condition is in because they have all this money they have to place, and they're willing to buy a 3 cap, a 4 cap. They're super excited if they get a 4.5 cap. So we're used to competing with those guys. But in Cincinnati, we said, hey, what do we need to do? Well, the broker said, 30 days due diligence is fine. No reason to do 2 weeks. So we did 30 days. And we said, what about 150,000 earnest money? He said, honestly, 50,000 is fine with my seller. We said, okay, even better. Great for us. And we said, what about a close time? We think it's going to take 90 days to close a deal. And he said, perfect. Let's do 120 because my seller's easy.
Now, for the earnest money, was that non-refundable from the beginning, or
Nope.
is that like only after the contingencies are? And now, are contingencies removed in writing, or does it automatically go hard after that period if you don't say something?
Yeah, so automatically goes hard after a certain date. That's how we write our contracts. Different states and different contracts will be different. I know in Utah that's how it is, and that's how we write our contracts. So let's say we go under contract June 1st, July 1st. If we don't back out, that money now becomes non-refundable, and no matter what happens, the seller gets to keep that money whether we close or not. And so if you're competing for a property and you know it's a killer deal and you want that property, a tip is to ask the listing agent, hey, to be competitive, should I do 2 weeks due diligence? Should I get my butt out there and finish due diligence in 2 weeks? That may be really beneficial because that's less time the seller has to take the property off the market and potentially have a canceled deal and have to put it back on if that deal doesn't work out with that buyer. And also ask them, should I do 100,000? Should I do more earnest money? So for a property that we just put under contract, we're actually the sellers. I knew I was going to have multiple offers, so I told the buyers, I'm going to give you 0 days for due diligence. Your earnest money is going to go hard day one. And no one liked it. And I said, look, guys, I have 5 offers. If you really want it, you're not going to have a due diligence time period. I'm going to give you all the information I have. And so that's what happens. So they put down $10,000 earnest money, non-refundable day one, and they have no way of backing out of the deal and getting that money back. That just may be what you have to do, but you better know your numbers before you do that.
And the reason you did that is to protect your seller in that case, because some buyers will try to get under contract at a price, just tie up the deal. And then once they do their due diligence, they'll try to renegotiate the contract at a different price. So, all right, you do a home inspection. Obviously, you test out the roof, the plumbing, the electrical foundation. What other sorts of due diligence do you do? Do you do tenant estoppels? Do you walk like if it's a 300 unit apartment, do you walk every single unit, or do you only walk a portion of the units, and why?
If you want to get screwed and lose money, don't walk all the units. The nice thing is, though, is you should have a team there helping you. And this is a team game. This is not a one-person game. So in Cincinnati, we walked all the units, but individually, we all only walked like 10 to 15 units because our property manager was there. We all had cameras, and our property manager had like 5 employees there with us taking notes. And so we knocked out 282 doors in one and a half days, I think it was.
Wow.
But we're taking notes. If you look at our hotel, there's 96 rooms, a restaurant, 2 bars, a pool. I did that myself. That was me for 4 days taking notes on if you looked at my spreadsheet, it would make you sick. I made this massive, disgusting spreadsheet notating every single item that needs to be repaired in every single room. And I know exactly what it's going to cost me to repair and renovate this hotel. If we had gone off our original numbers for the hotel, we would have been, I think, $200,000 short on our rehab budget.
Wow, $200,000 short. So yeah, that's why it's important to do the due diligence. So you probably hire a roof inspector, a plumbing guy.
Yep.
Probably hire like a electrical guy to go out and take a look at the electrical as well too. And
absolutely.
Basically walk every single unit, and then you verify the income as well too. So part of your due diligence is verifying the rent rolls, verifying numbers, making sure
our property manager helped us with that as well. They went through every single lease and verified every single lease.
That's awesome. And a tenant estoppel, just so that the consumers know, is basically where the tenant verifies how much they're paying in rent and how much they're paying in deposit, or how much they have in deposit. Just because one of the things that you want to make sure you do when you're buying an investment property is make sure that if there's deposits that are owed to the tenant, that those deposits get transferred to you at the close of escrow. Because even if they don't get even if you don't get the deposits, you're still liable for them because the tenant paid it to the previous owner. So it's definitely one thing that you want to make sure that your escrow company does, and basically that you get estoppels and make sure that that money gets transferred to you. Now,
Right.
do you do laundry units in your apartment complexes, and do you self-manage or do you hire a company to do that?
Yeah, that's a really good question. I want to make as much money as I can with as little headache and brain damage as I can. So if there's a good management company available that will service all those units so that my maintenance guy doesn't have to be tearing apart washers and dryers, absolutely I'm going to have some type of contract with a third party to take care of those washers and dryers. The short answer is you want to have as many amenities and also income streams as you possibly can. So why not have vending machines on site? One amenity in a place where maybe you're buying a C or a C minus asset that's in a place with maybe some crime issues. Why not pay for one of the units to be turned into a police substation? I have a good friend that's done that multiple times. We've offered to do it with our hotel in New Mexico. The police love it. They have a place to eat donuts and drink Red Bulls and do their paperwork and maybe play video games and go on break rather than driving all the way back to the police station. And the police in Farmington, New Mexico, they love us, man. We buy them lunch and dinner all the time. So there's lots of different ways to increase the revenue, but also make the property much better. And those are things you want to look at beforehand when you're doing your analysis. Can I add a dog park, or can I add X, Y, and Z to make it a better place to live? And what else can I charge for and make money on? In Cincinnati, we're going to add smart home systems. And it's going to cost people $20 a month to have a smart home system where they can have a camera, they can control their thermostat. When their kids get home from school, they can check on them with a camera. Their kids can check in. We don't really know how much that's going to generate for us on income, so we didn't put it on our pro forma. But if it does, it's going to add a lot to our bottom line, and I think some tenants are going to really like it.
That's awesome. I'm glad to hear that. Good. Last thing, what are some quick tips to find good quality tenants? Any quick tips to just make sure that you're getting good quality people in there?
Yeah, I mean, you need to advertise really well. So I self-manage all my units here in Utah, and I always rent my units for more than property managers do.
Mm-hmm.
And the number one thing I see is their pictures and their advertisements kind of stink. They're not very good, and they don't answer the phone. So guess what? A good quality tenant, they don't have time to wait for you to call back. You're going to lose a lot of really good residents that way. And so I actually have investors where I will take over managing their units for 1 month. And I'll fill their units with much better high quality tenants who are paying 10 to 15% more than their property manager could get, simply because I do a really good job marketing, and me or my assistant will answer the phone. Now, that's in extreme situations. I don't make money. I'm not a property manager. I do that to prove property managers wrong and make them look bad and to give my investor a good reason to fire them. So it's sad, but honestly, that's, if you can just nail that as far as advertising and doing a good job with lead conversion. There's a guy that you got to check out. His name, what's his name? It's Leasing University. I can't even remember the guy's name. All I know is he is the best training system for property managers and leasing agents, bar none. It's Leasing University. And what he talks about is you're a salesperson. People need a place to live. They just need to be sold on why yours is the place for them, to lease. So I would say it comes down to property management 100%. And that's why a property manager will make or break you.
And I think it's so important when you said that you call the companies sometimes to see if they answer their phone.
Secret shopping.
It's so important because essentially, if they don't answer their phone, they may say, "Oh, well, we haven't been able to find tenants 3 months, and essentially it's not that they haven't found anything. People have called, but they just haven't answered their phone, which
Yep.
basically decreases the revenue, which makes the value of your building go down, which I think is basically very important. Last question, and then we're gonna basically sign off. What is your exit strategy with some of your buildings? Like, I know for some people, they buy the property, they rehab it, they rent it, increase the rents, then they refinance and get most of their money out. Or are you looking to sell? What's your holding period? What is your vision as it relates to that?
Yeah, really good question. Our business plan is very simple. Make as much money as we can, as conservatively as possible. So we're always going to do a 10-year loan, but we're always going to either refinance or sell as soon as it makes sense for our investors to make a really good return. I mentioned 15% return on investment per year. If we can hit that for our investors and take that gained equity into another deal where we can do that again, we're going to do that as soon as we possibly can. But if we need to, we can hold a property for 10 years. And if we're running it correctly, we can refinance in 10 years if the economy isn't doing well. So with that said, we're always going to try and refinance year 3 and get at least half of our investors' money out. That allows their risk or their risk profile to really go down. They're mitigating their risk by getting 50% of their money back out, and it allows them to duplicate their investment, or really 2x and 3x their investment in the same amount of time. So hopefully they'll reinvest with us on another deal once we give them about half their money back at year 3. So we're always thinking long term, and we're always thinking how we can maximize ROI, but not take unnecessary risks.
That's so awesome. And I think it's so important to have an exit strategy. I'll tell you this, Sam, when I started investing in real estate, I never thought about an exit strategy. What I saw growing up with my dad putting 20% down on a property, holding it for 30 years, and that was pretty much it, paying it off as fast as possible. But what I learned through being around certain people is that you have to have an exit strategy, meaning that my favorite exit strategy now is, I'll put 20% down on a building, but as soon as I see the opportunity to get my 20% out and the property still has a good DCR and the property still produces good rent, I'll get my money back out and I'll reinvest it into something else. And I never used to think about that, like from a investment perspective. So I know that was really big for me. Sam,
that's really smart. And let me just add to that. That's the reason we do value add. What you just said is so smart. You'll make money so much faster by doing value add deals, because you increase the value, and you're able to refi and pull that money back out and reinvest into another good deal rather than just letting it sit there. So that's why it's smart to sell or refinance, because you have all this equity in a property that's increased in value. It's not earning you any extra money. It's just sitting there, not being used. And so these sellers, I'm sure you get this all the time with your clients. They say, well, you just want me to sell because you're a realtor and you're going to make a commission. Well, yeah, I like making money, but guess what, Mr. Investor? You have $200,000 sitting in a property that you just earned over the last 3 years that's earning you zero. That's free money that you just earned, and it could be earning you a 15% return year over year. So my commission is almost nothing compared to the money that you could be making. And so again, that's why value add deals are a really good opportunity to 2x and 3x your money and your investments.
Yeah, absolutely. I agree with you even more. And I think that's more advanced for some of the viewers that we'll have, like essentially. But I think that us being able to do this can open somebody's eyes and really be like, okay, good. Is this the best use of my capital? Now, I'm a steward of capital. Basically, I'm always looking, is my capital earning the highest return possible to maximize my return? And how do I minimize the risk? Obviously, I don't want to refinance. I've had clients that tell me, well, my rent is $3,700. My rents are $3,900. If I refinance, it's $4,100. So now they're negative on the property.
Yeah.
I want to take money out, and I'm just like, look, that doesn't make any sense, because now you've got a property that's not cash flowing, and you've got a property property that is producing negative cash flow. So yeah, refinancing is great. It's a non-taxable event, meaning you get to pull the money out. If you sell the property, you obviously sometimes have to pay capital gains. So that's a big benefit. Sam, where can people find you if they need to get a hold of you, if they want to buy a property in Utah or Idaho, or they just want to pick your brain about investing in larger apartment complexes? Where can people find you?
Yeah, thanks, man. I really appreciate being on here with you and love talking investments. So, first of all, I don't know if you want to post my phone number. I love talking investments with people. You can text me or call me 801-995-2220. I'll text it to you so you have it. But I'm on Facebook all the time. You can Facebook message me, just Sam Newell. I also have a podcast that I launched specifically to teach people how to have a recession-proof, conservative, high-returning investment, and it's called Recession-Proof Real Estate Investing. It's pretty simple. So check out the podcast there. I've had some huge, just heavy hitter, very, very experienced investors on there, and the goal is just to add value and teach people how to not make mistakes and make great money in investing in real estate.
Awesome, Sam. So I want to say thank you. I know that this show went a little bit longer than expected. At the same time, I know that once it's finished, it's produced, it's going to provide a lot of value for people that are looking to get into larger multi-unit apartments. I thank you from the bottom of my heart. And obviously, I look forward to working together with you in some capacity in the future.
My pleasure, buddy. Keep killing it. Love what you're doing. And you're an awesome individual. So it was my pleasure.
Thank you.